Welcome to J.K. Michael's Knowledge Series. This is the Career Improvement Series. Today, we'll focus on financial management. And our topic will center on how to create and manage a personal budget. A budget is an estimate of income and expenses for a given future period of time. For budgets to be effective, the projected income and expenses should be reviewed on a regular, specified basis to enable the user of the budget to identify if they are meeting their projections or if there are any variances that should be resolved. Budgets can be created at any economic level. Corporations and governments may create and use budgeting, as well as individuals or households. Our focus for this video will be on the individual or household application of the principles of budgeting. Why is budgeting important? We should use a budget to manage our finances because budgets, number one, help us control our monthly spending. Number two, prepares us for unforeseen circumstances. Number three, enable us to plan for the acquisition of luxury products without falling into debt or going completely illiquid. Number four, a personal cash flow budget will help you to establish your financial priorities and ensure that you have the capacity to purchase essential expenses and the flexibility to determine how you would like to save or spend your money. To use a budget effectively, your budgeting skills do not need to be on par with those of a finance professor. Neither do you need to be brilliant at arithmetic. And while a budget could act as a guardrail against making unplanned purchases that may land you into financial trouble, keeping a budget does not mean that you cannot buy the items you want. The advantage that a budget offers is that you'll be more aware of where your money is going and in charge of your finances. This video will simplify the budgeting processes for you and show you how to create a simple, comprehensive budget for use in managing your finances. And we'll cover this in 5 simple steps. Number 1, determine your current financial position, bank accounts or loans. Your financial position is simply an updated statement of your assets against your liabilities. In personal financial terms, this is known as a statement of net worth. In corporate management, it's the equivalent of your balance sheet. What is the current status of your account, cash, bank statements, and other assets such as land, houses, automobiles, and investments? While your total financial position might be important in financial planning, budgeting, however, requires planning over a shorter period, such as month to month or year to year. In this situation, shorter-term financial information might be more useful. If you have a $50 million asset as a house, it would form part of your financial status, but unless you're planning to sell the house and use the funds over the period in review, it will not be a very important information on your budget, or perhaps you may have to regularly pay for maintenance and taxes, and then that might be a consideration in your budget. Also, long-term debt would have no role on short-term budget unless you're servicing the debt with current income within the period. Check how much money you have in your bank accounts and other investments and then determine how much money you owe, and this should reflect mostly in your current and short-term assets and debt. Step 2. Determine your anticipated income over the next 12 months. If you're paid a fixed periodic wage or salary, this activity would be as easy as looking at your pay slips. However, those who own businesses or are self-employed might find this requiring slightly some more effort. It is therefore important to discover how much you are likely to receive within a period, and these calculations should consider taxes and recent business quarterly statements. You may also ask your accountant to advise on tax payments. Your projected income should be totaled and all-inclusive of your paycheck, tips, royalties, alimonies, or investment income. When you know how much you make per annum and when you make it, then you can allocate it to your budget in the months where it will actually come into your bank account. Step 3. Determine your anticipated expenditure over the next 12 months. Be careful to make an honest and objective assessment of your expenditure as you list out all your current expenses. For accurate evaluation of how much you spend, you may track your expenses for a month or longer, organizing your expenses into categories like fixed expenses, variable expenses, and discretionary expenses as shown in the documents attached to this video. Maintain a spending log. Keep a record of every dollar you spend for a month. whether you buy with a cash or credit card, to determine what your true out-of-pocket costs are. Make sure to include utilities, subscriptions, and automated payments. Fixed expenses may include mortgage payments or rent, vehicle loans or lease, other loans, insurance, education, savings plan, and other expenses with fixed or monthly or weekly payments. Variable expenses will include groceries, utilities, phone bills, maintenance, clothing, transport, and medicals. Discretionary expenses will include any expense not directly essential to day-to-day living, such as entertainment, clothing, furniture, holidays, sports, cost pocket money. Now, step 4. Do your calculations to determine if you have enough to cover your expenditure in each month. In this phase, your costs must be subtracted from your revenue. You can choose to calculate this depending on your income and spending on a weekly, fortnightly, or monthly basis. Most people prefer to use the monthly option. Ensure that in this projection you include mandatory expenses, debt payments, payments of insurance premiums, and so forth. What did this evaluation tell you? Do you go overboard with your spending? Will you be able to predict periods of financial trouble in the upcoming year? Or do you manage to pay for all of your expenditures while saving some cash? If your spending is significantly higher than your income, then you need to reevaluate how you manage your expenses. If your income and expenditure are more closely matched, you could opt to adjust your spending habits to enable you build savings. Step 5. Set financial goals. Do you desire financial savings or to repay debt? Do you find yourself spending too much? If you decide, for instance, to restructure your expenses after all your fixed and variable expenditure have been taken into account, determine a budget that is reasonable for you to spend each week. You can do this by objectively assessing the costs that you can or cannot change. Identify your most achievable objectives. Keep in mind that you can change these over time. Decide on the most urgent objectives are first, such as debt repayment or setting up an emergency fund, and ensure that your goals are always smart, specific, measurable, achievable, realistic, and time-bound. Step 6. Monitor your progress and review continuously. At least once a month, you should check your personal budget to make sure that your income and spending patterns are in line. Are you ending up with a budget surplus, which means that you are able to find some money to save or invest? Or are you in deficit, which means that you are having to take loans to meet your needs? Do you need to adjust your spending patterns to better fit your income flow? Remember to keep your budget flexible. If life happens, you want to be able to deal with uncertainties, and a flexible budget will help you to avoid overspending. Do you find yourself saving more money than you initially intend to? Then you might need to check the SMART goal list again to ensure that your budget is serving your needs. The personal budget will be kept practical, realistic, and relevant to your needs as long as you continue to review and regularly update it. To summarize, a budget is an estimate of income and expenses for a given period of time. For budgets to be effective, the projected income and expenses should be reviewed on a regular, specified basis to enable the user of the budget to identify if they are meeting their projections or if there are any variances that should be resolved. Budgets are important because they, number 1, help us to control our monthly spending. Number 2, prepare us for unforeseen circumstances. Number 3, they enable us to plan for the acquisition of luxury products without falling into debt or going completely illiquid. Number 4, a personal cash flow budget will enable you to establish your financial priorities and ensure that you have the capacity to cover essential expenses and the flexibility to determine how you would like to save or spend your money. A comprehensive budget can be created to manage your finances in 6 simple steps, and they are: number 1, determine your current financial position, bank account and loans. Number 2, determine your anticipated income over the next 12 months. Number 3, determine your anticipated expenditure over the next 12 months. Number 4, do calculations to determine if you have enough to cover expenditure in each month. Number 5, set financial goals. Number 6, monitor your progress and review continuously. For more information on financial management and more specifically creating and maintaining a personal budget, please check out our website on www.jkmichaelspm.com. We have an endless stream of trainings, courses, and materials to enhance your development. If you haven't yet subscribed to our videos, please like and subscribe by hitting the red button with the subscribe down below. Now for my question: should your budget factor in risk and how to mitigate it? And how would you handle uncertainties or unforeseen circumstances when budgeting? And also please give us reasons for your answers. Enter your responses in the comment section. We will go through your comments and respond or offer feedback as required. Thank you for watching this video. See you in the next video.